Hi, welcome to Elevate Market Chat. This month's episode was recorded on May 23rd, 2024. Shane and I kick off this episode with a discussion of inflation and adjusted rate expectations. We then dive into commercial and government debt. We'll finish off by addressing the resurgence of some of the meme stocks, including GameStop and AMC, before getting into NVDA and their latest earnings release. Thanks for tuning in. The following is presented for informational purposes only, and none of the information contained herein constitutes a solicitation, offer, opinion, or recommendation by Elevate Capital Advisors or any of its employees, officers, agents, or guest speakers to buy or sell any security or to provide legal, tax, accounting, or investment advice regarding the profitability or suitability of any security or investment. Opinions and analysis are based on information from sources believed to be reliable. All investments entail a certain degree of risk, and financial instrument prices can and may go up or down based on any number of factors. Consult your financial professional before investing. Hey Shane, so today is May 23rd, and it's been a month since you and I got to connect, and we had NVIDIA last night, and now we're looking at overall stock market is often measured by the S&P 500 is up year to date 11.25%. So how have you been since then?
Oh man, I've been good. Thanks for asking. I know you've been good. You found me some antlers to send for the dogs to eat because the inflation has gotten so crazy that I can't afford to buy the antlers from the pet store anymore. So thankfully, I got a guy in Colorado who can just go walk around in his backyard for a while and find some and send them to me. Although you're not doing that for free either.
I try to, but I do have to fill the truck up with some gas to go find those. And if I, track my hourly rate, I'm probably not doing too well.
Yeah, and postage is probably more expensive as well. So, because of course it takes some fuel to get that stuff here. But yeah, fuel costs are a big thing. It's funny that inflation numbers often exclude the fuel and the food because they're just too volatile for the government to want to report unless it suits their purposes. So yeah, I've been good, man. How about you?
I've been doing well. So getting in shape out there hiking around. So that's a good thing. And then, I'm sitting here and as you know, I watch the markets daily and I'm a little shocked. We're sitting here, markets are up, but inflation has been the hot topic all year. And I'm just curious, since the last time we spoke, what's kind of been the main thing you're looking at in that regard?
Yeah, not even all year. It's been like for several years. It was only what 2 or 3 years ago now that Jerome Powell said that inflation was going to be transitory and it wasn't going to be something we had to worry about. And 3 years later, here we are with inflation nearly double the Fed's target of 2%, and it doesn't seem to be going down anymore. We just got minutes from the most recent Federal Reserve meeting that ended on May 1st, yesterday, Wednesday, and not many, but various members of the Fed were okay with hiking rates, certainly not cutting them. And so people have been looking for the Fed to cut interest rates and pivot from hiking rates to cutting interest rates for almost 2 years now, and that still hasn't happened. Hasn't stopped the market from rallying on those hopes and dreams that people have of interest rates going down. But as I've written about in commentary after commentary, if the Fed does cut rates, they're just going to reaccelerate inflation. So I don't see them doing that anytime soon. And the market is increasingly coming around to my view. At the beginning of this year, they expected the Fed to cut interest rates 6 times in 2024, starting in March. The Fed has not yet cut interest rates, and now there is expectations from the market for maybe one interest rate cut. As it stands today, I still think there will be none, and the market seems to be coming around to my view on things. So inflation has not really cooled. The inflation data we got recently for April of 2024 showed a slight decrease from the prior month, but still 3.4% for the headline inflation number and 3.6% if you exclude food and energy in the so-called core inflation. I don't like the core inflation number myself, just because everybody has to buy, pretty much everybody has to pay for the expense of food and fuel. So eliminating that from the calculation doesn't make a ton of sense to me, unless it suits your narrative. So, I mean, in March, the annual rate of inflation was 3.477. They generally round up to the nearest tenth, so reported at 3.5. And the annual inflation rate in April was 3.40, so a little bit lower, but still well above 2%, closer to 4% than 2%. And the core inflation number was 3.8% in March. The annual core inflation was 3.8% in March. And reported for April, it was 3.6%. So still, again, closer to 4% than 2%. The Federal Reserve has no business cutting interest rates in this type of a situation. We haven't printed a lower annual inflation number since June of 2023, and it's currently May of 2024. So inflation is not falling, certainly not falling, and disinflation has sort of stalled out, and seems to me like inflation is kind of re-accelerating.
Mm-hmm. And Shane, when you mention expectations, so we started at 6, now it's at 1. For newer listeners, what is the measure of actually where those expectations come from?
Well, like anything else, you can bet on this in the futures market. So there's this thing called Fed funds futures, and there's a contract that you can go bet on, for lack of a better term. It's definitely a lot like gambling, but the idea behind it is that this financial instrument is created to provide a hedge to primarily bond traders and people who have large fixed income portfolios like banks and big funds and things like that. So it's just a way to bet on, hey, if interest rates go up, my portfolio is going to lose money. And so if I can go long the futures contract on interest rates going up, and that happens, well, the gains from being long that futures contract will offset losses from my portfolio. So that's what it's designed for, but there's no requirement that you have to have a large fixed income portfolio to hedge, right? There's often speculators that get involved in these futures markets where they don't have any position. They're just gambling. They're saying, hey, if rates do this or that, I want to make money on it. Whether I am hedging a portfolio or not makes no difference. So the futures market, whether it's corn or oil or pork bellies, there's speculators and then there's hedgers, which are called the smart money. But that's a big long conversation. But that's where the information comes from as far as pricing expectations for a certain number of cuts. And by the way, Kyle, if I had told you at the beginning of the year that the market was expecting 6 rate cuts, and by May there were 0 rate cuts, and the market is no longer expecting any rate cuts, what would you think that the stock market performance would look like?
So right now it's up 11.25%, and I would say if you put a minus sign in front of that 11, that's probably in line with where I would imagine it to be.
Right. That's what fundamental economics would suggest is that those expectations being so badly missed should have corresponded to the market being down, but instead the market's up. And why is the market up? Well, because the biggest stocks just keep on getting bigger.
Yeah. And that's the hard question to answer here, is why isn't it playing out that way? Because we're sitting here, the Fed's fighting inflation. Meanwhile, the government's also doing measures that are inflationary. So you may have seen the recent article now is, Biden came out and canceled $7.7 billion in student debt, throwing a lot more money out there. But then, something I know, maybe you saw this coming from Danielle Martino Booth, but commercial real estate, that's been kind of under there lurking, where that and other debt is telling this story that is very different than what the S&P is telling us or the overall market. What have you been noticing in that?
Yeah, so commercial real estate is a big underlying issue that has been a big underlying issue for a while. These things take time to play out. If you look all the way back to my May 2023 market commentary, which I think we'll post a link to, I posted a chart that showed that there was a lot of commercial real estate that needed to be refinanced and was going to be maturing over the course of the next year. I mean, it was over $1 trillion, if I remember right. And that has started to happen, and a lot of commercial real estate loans are defaulting. That will probably lead to more bank failures. More banks have failed since last year when Silvergate Bank or not Silvergate, Silicon Valley went bankrupt, and New York Community Bank went bankrupt, and First Republic Bank was bought by J.P. Morgan. Those were some very big bank failures, and since then there have been several more. We're just not hearing about them in the media, and none of them have been quite as big. But Jerome Powell said very recently, this is the chair of the Federal Reserve. He said during his most recent testimony in Congress that commercial real estate bank failures was going to be a problem for years to come. We were going to be working through it for years to come. So it's something that's going on out there, and the higher rates stay for longer, the more of a problem this is going to be. So from that perspective, the Fed probably wants to lower interest rates, but like I said before, the more they lower interest rates, the higher inflation is going to go, which is a problem as well. So there's no easy way out of any of these situations, and trying to thread the needle is a very difficult game to play. So far, we haven't seen a material impact, at least to the downside on the stock market since 2022. But I don't think these problems have gone away. I think they're still there. I think they're still very real. I think when they do finally materialize, it'll be a very quick trip down for stocks. And how low it goes, nobody knows. But stocks are very, very overvalued on pretty much any measure you can imagine fundamentally right now. But people just keep buying stocks, and there's nothing for it, right? You gotta pay attention to what the market's doing, whether you believe it's reasonable or rational or not. The more people buy, the higher the market goes, and it seems to me like people are concentrating all their money into the biggest names, just like they have been for a while now. So that said, there was a recent run up in some of the meme stocks, which I think we'll get to in a little bit.
Yeah.
So yeah, commercial real estate's an issue, though. I mean, there are a lot of companies out there that own really big buildings that are empty.
Mm-hmm.
And so between trying to force people back into the office just to justify the expense of the office, and just simply not having the capital or the ability to refinance the loans that they took to buy these properties, right? When they took the loans, they were probably 3 or 4% interest, and now they're going back to the bank, and the bank's saying, "Hey, you owe me $1 billion," right? And the company says, "Well, I don't have $1 billion. I need to refinance this debt. I want to borrow $1 billion from you, and push it out 5 or 10 years or whatever." And the bank's saying, "That's cool. Interest rates have gone from 3 or 4% to 9 or 10%." And then the company says, "Well, I can't afford the interest on that." So no thanks. And we file for bankruptcy, and that's that. So the more that happens, the more banks will fail. The more banks fail, the more concentrated our banking industry will become, which is probably not a healthy thing. And all of that kind of stuff from the banks just trickles through the market and eventually becomes a very large problem, sort of like what we saw happen in 2008, 2009. Like it wasn't a problem until it was a problem.
Yeah. And then how do you think about it in terms of you're describing, commercial real estate, which is the big company, one, somebody you might work for, and then you're describing the bank. So there's kind of that view of, well, it's not my personal situation, but it's the big guy, the big corporation. They make too much money. How does that feed through to the everyday Joe?
Yeah, it's a good question. You might actually have a better answer than me, but it could be a very long answer. But for most people on this call, the real issue is that if the bank loses enough money on these loans, right? So if the bank has $1 billion and they lend it to, XYZ company to purchase a building, and they're expecting XYZ company to pay that $1 billion back with interest over 5 or 10 years. Well, if 3 or 4 years later, or even 5 years later, the borrower comes back and says, well, I can't afford to pay you anymore. And so far they've only paid 100 million out of the 1 billion back, plus some interest. Well, that $900 million that's remaining just goes to money heaven. That money's gone. Well, whose money was that? That was your money and my money. The $1 billion that the bank loaned to XYZ company to buy that property was the money that you and I think is sitting in our checking accounts and savings accounts, right?
Mm-hmm.
I mean, that was the money they used, and it's a little bit more complicated than that due to the fractional reserve nature of the banking system. But I mean, that is the money, right? So when the bank loans money to a business to buy a property, or to a person to buy a home, or to a person to buy a car, or to a person to pay for college, that money didn't just come from the bank. That money is the money that the bank is holding on to for people like you and me. And all we see is when we go log into the website and we see our bank balance, it says, hey, you've got $1,000 in your checking account and $2,000 in your savings account. Well, that money's not actually sitting there. It's that money has been loaned out to borrowers, and that's the bank's business. They're paying you very little interest on your checking and savings. They're still paying very little, which is amazing given that you could go buy a US Treasury that matures a month from now and get 5% on it. But that's another matter.
Yeah.
But ultimately, that money is not sitting there. It looks like it's there, but it's not there. If every single person at every single bank went and said, "Hey, I want the money in my checking account today," the bank would not be able to provide it to everyone. Like
Right.
it does not work that way.
And that, it is protected by FDIC insurance, which in the end kind of takes back to the big government saves all, prints some money. But, the feed through there too is just the credit spreads. So if I want to go buy a boat, a house, anything, and I need to finance that, you look across the entire spectrum of lending. So it starts with the government, which treasuries, that's the safest. And then you step up to like corporate. Well, unlike you or I, a corporation has multiple income streams that they can repay debt. So they're pretty safe. And they look at the spread. So if treasuries are, say, 3%, corporates are 5%, that means there's an extra 2% that's counting that risk. Well, now here's Joe. Joe wants to go start a business. He's not going to get 5% as an interest rate on that debt. It might be 7 or even higher than that because he has more risk than these established companies that are defaulting. So now you don't have small businesses starting. They don't employ people. People have less money. And now you have that vicious cycle, right? Where everyone along the way starts to get hit.
Yeah, well, and I mean, even in addition to that, if you really play it out to the FDIC insurance situation, is like, number one, it's only supposed to be backed up to $250,000. So if you have more than $250,000 in your bank account, everything above that is technically at risk. Last year, when these banks were failing, the FDIC decided to guarantee, pretty much an unlimited amount of capital, and the $250,000 limit didn't apply, which just creates a lot of moral hazard. But neither here nor there. This is the interesting thing to me, is that the FDIC doesn't have enough money to do that. So they say, oh, we're going to guarantee all this money, unlimited amounts of money at all the banks. So everybody kind of has this mindset now that the $250,000 limit doesn't apply anymore. Well, again, just playing it out, this is an extreme example, but again, if all the banks out there had the same problem and the FDIC had to insure every single dollar at every single bank with no limit, they simply don't have enough money to do it. It's not even close. I mean, it's orders of magnitude too large for them based on what the FDIC actually has and the amount of capital, to guarantee these things. And so ultimately what would happen? Where does this money come from? Well, it gets printed. What happens when you print a bunch of money in an economy that already has 3.6% inflation? That, if you printed enough money to actually be able to guarantee all those deposits, inflation would be like 30%. It's like, it's not, and I'm just making
Yeah.
up numbers, but it would be something just absolutely insane. There would be hyperinflation in this country. So yeah, they would guarantee all your money. They just print it up and give it to you. But a gallon of milk will cost $100,000 too. So
Mhm.
it's not really doing you any favors.
And, this might kind of just wrap up this topic here, but, Shane, I shared it with you. Lynn Alden, she's an economist out there and does some pretty good work, but there were some stats that she had written about that caught my attention. And it was, from the 80s to 2000s, the debt to GDP was 30%. 2008 to about 2018, 65%. We're at 120% right now.
Yeah, and the
So,
projections are bonkers. It's only going to go
yeah.
higher.
So we're in this world where it seems as though modern monetary theory does work, right? We're just going to print as much money as we possibly can, and somehow this debt goes away. I don't know, but these are just numbers that kind of blow your mind. And she went into it and how it impacts the inverted yield curve and why it means nothing. But yeah, listeners can go look that up. Unfortunately, we just don't have time to get into it.
No, we could be here
But
all day. Yeah, and I'll tell you what, modern monetary theory isn't working for all the people who are currently homeless, which is, the instances of homelessness in this country are higher than they've ever been, and suicide rates are on the rise. So when it really boils down to how well are these monetary policies working for real people out there? They're working fine for Jeff Bezos and working fine for Elon Musk and working fine for the majority of people who are going to be listening to this podcast. But you're not crazy when you look around and you're driving through your city, wherever it is, and you look and you're like, gosh, I don't remember there being this many homeless people when I was younger. Well, there weren't, and a lot of people are really, really, really struggling, and these policies aren't working for them. And I don't know, maybe that'll lead to people voting a little differently when November rolls around. We'll see.
yeah, so we'll see how that plays out. But turning back to stocks, where I kind of saw some of this play out, and you might have a different view here, but you mentioned the meme stocks earlier at GameStop. So Roaring Kitty posted a meme of a guy in a chair leaning forward on Twitter, and that just lit, GameStop on fire, and it doubled overnight. And my takeaway that I was paying attention to on that is that people that are going to be playing that, I don't view as having much money. And it kind of sounds to me when I see that, it looks like a shot of desperation in a way. Where can I go get fast money because I'm hurting, likely on the personal balance sheet side? That was something I was looking at there. But what was kind of your big picture theme? And I'm sure, I mean, were you surprised to see that at this point in the cycle?
No, nothing surprises me anymore, Kyle. And Roaring Kitty, what a thing to talk about. This guy's screen name. I think his name is Gil or something like that. I can't remember what his real name is. But for those of you who don't know, there are movies about it on Netflix and other places. So go check those out if you want to understand more about who this guy is and what's going on with these meme stocks. But yeah, like Kyle said, this guy posted a very quick image on Twitter or wherever it was. Maybe it was Reddit. I don't know. And GameStop promptly rallied by like 500%. The stock did, and I even had clients that wanted to get involved and take advantage of this. The stock went from about $10 a share up to about let's see, $65 a share. It increased by $54 in 19 days, up 528%, which is only funny because a few years back when the original meme stock rally happened and GameStop was the best performing stock in the entire stock market back in 2021, right at coming out of COVID, the stock had rallied, over 2,000%, like 2,500% in early 2021. Well, back in 2021, it dropped subsequently by over 90% in the next couple of weeks, and GameStop this time around, after its 500% rally, is currently down 69.4% over the subsequent 8 trading days. So this one hasn't lasted didn't go quite as high, hasn't lasted quite as long. But that said, back in early 2021, after so it started off by rallying, say 2,000 plus percent, then it dropped by 90%, and after that, it rose again by 744%. So maybe we're just seeing a good pullback, and right now is the time when everybody should be going out and reloading GameStop for another run higher. You just never know, man. I mean, these things, these are short squeezes. We probably don't have a lot of time to get into what a short squeeze is and how it works, but it's people aren't buying GameStop because it's suddenly a great company and it's going to be the next Apple or NVIDIA. It's just a function of people are being short the stock and then being forced to buy it to get out of their short sale, and it just pushes these stocks way higher than they deserve to go, and then they come crashing back to reality. So this is a trader's stock. It is not something that you should be going investing in my opinion. But do your own research. We're not on this podcast to recommend trade ideas or stocks or anything like that. So this is all for education purposes, and I would encourage you to just go out and watch the movies and the documentaries that are on the various platforms if you want to get a better understanding of what's going on, because it might be happening again. I mean, this guy might go out and tweet something this afternoon that'll cause GameStop to go up by 500%. And if you get lucky enough to buy it early and know when to sell it, you can make a lot of money. But if you buy it, at $60 and tomorrow you wake up tomorrow, it's only worth 10, you can easily lose 80 or 90% of your money too. So just be real careful with that. And it's just a sense of it's just a sign of the times. I mean, people want to gamble. People are looking at this stuff and they're saying, I don't have anything to lose. Why not? I'll put $100 in this thing and see if I can turn it into 1,000. I mean, why not?
Yeah. And, Shane, it's interesting as you talk about some of these metrics, how GameStop doubled in this recent run, and that's a big move. And I look at NVIDIA, which reported last night, and I would say it's doubled now from the start of the year. What's the big deal? Why is it that GameStop doubles and it doesn't necessarily send out such a big message, but NVIDIA doubles and I mean, that's a big deal. Like, what about market cap? How does that factor in? Because I know we've had some big news there, developments, I would say.
Yeah, again, we're running out of time, so I don't have a ton of time to get into it. But ultimately, I'll just say that NVIDIA is growing rapidly, and it's a much bigger company with growing revenue, and it's a lot of revenue to begin with. Here's the thing, though, is that NVIDIA is currently priced. Like the current price of the stock in the market implies something about the future. Right. So that's what the market does, is it prices future cash flows. Something is worth today the present value of all the cash flow it's going to generate to the owners in the future, whether that's in perpetuity or over a limited amount of time, a finite life. That is what drives the fundamental value of a stock today. And if you look at NVIDIA, what the current price implies about the stock is, and there's different ways to do this, but the way that I've looked at it is that the market is basically pricing in today that NVIDIA's revenue will grow by 86% or something this year, and then 20% a year after that forever. And that margins will be, say, 52% profit margin. So that's net operating profit after tax. So that's the money that's available to shareholders to, say, pay as a dividend or buy back shares or whatever, right? That's the net operating cash after tax. And it's available to pay interest to the bondholders, that type of thing. Which 52% margins, right? So if you earn $1, that means 52 cents is available to you. That's a very high net operating margin after tax. And it's also much higher than what NVIDIA has done in its history. Its historical average is only about 30%. So if I go and plug into NVIDIA, what if it, grows revenue by 86% this year and then 22% every year thereafter? And what if it generates 52% net operating cash flow margin? And then I discount all those cash flows for the next, for every year for the next 30 years. What it shows me is that it will be worth it'll be worth what it's actually trading for today in 16 years from now. And in year 16, at those growth rates, it assumes that NVIDIA's annual revenue is $1.7 trillion, which is just absolutely insane.
So the big takeaway here, right, is that two things. One, the value of NVIDIA stock now is worth more than Amazon and Tesla combined.
Yep.
And then you've got these assumptions that are lofty to say the least. And not saying that can't happen, but if you're buying it now, that's what you're buying it on. Like, understanding that, I think, is the important part, is that these big numbers and expectations have to come to fruition and hopefully even surprise to the upside. And probably not looking so good. Great company.
The total GDP in the United States of America was 25 trillion. So you're talking about 16 years from now, NVIDIA making up 10%, almost 10% of the entire national GDP. I mean, look, could it happen? Sure, but not without a ton of inflation, right? I mean, I don't know where those $1.7 trillion are going to come from. And yes, NVIDIA has global revenue. I get that they're not just doing business in the United States, but I'm just saying, is it reasonable to think that any company will be doing that much revenue in today's dollars 16 years from now? I think it's absolutely crazy to think that, to be honest. But that's what people are paying for. People today, and there's lots of ways to do this, right? I could say, well, what if the margin is lower but the revenue growth rate is higher? Or what if the revenue growth rate is lower but the margin rate is higher? There's all types of ways to mess with these numbers and kind of figure out what is the current price of the stock implying about future expectations. Like, what are people paying for? What I can tell you is that they're paying for astronomical growth of, 200 and some percent, which is what NVIDIA has been growing at, over the past year or so, as far as revenue concerns. And margins have been growing, right? But the idea that they're going to be able to sustain this is just absolute nonsense. And we'll put a link to a recent post, my post from last night, on LinkedIn, where I posted a couple of charts on LinkedIn about how NVIDIA's revenue growth is already beginning to fall. And don't get me wrong, it's still extremely high, right? I mean, it's still growing rapidly, but it's not going to maintain 265% growth. It's just, It's just not going to happen. I mean, it does not work that way. And if you extrapolate that out, the prices implied are just absolutely crazy. So ultimately, even based on these really lofty expectations, it's still going to take 16 years for NVIDIA to grow into its current valuation. And I just think that's way too high of a price to pay for myself or our clients. So we have some exposure to NVIDIA, but I would not be buying it here. Well, Kyle, let's leave it there for today, man. It looks like we're getting a little bit of a sell-off in the markets, even on the back of this amazing NVIDIA earnings report that came out last night. The market's pulling back a little bit more than 0.5%. NVIDIA is still up about 10% for the day, but starting to fall a little bit as well. Crypto's dropping a little bit today, so maybe more of a risk-off environment, because NVIDIA, even though they reported amazing earnings that beat expectations, as we were just talking about, seems like all those expectations are already priced in. And as NVIDIA isn't gonna, grow by an extra 200% a year, maybe those expectations will start to come back to reality along with the rest of the stock market.
Yeah, certainly could be happening. So, Shane, thanks again for your time, and look forward to seeing you on the next podcast.
My pleasure. Talk to you in a month, man.
Yep. Bye.